Topic introduces the securitization process as a structured financial technique used to transform illiquid assets into tradable securities. Financial institutions pool assets such as mortgages, auto loans, credit card receivables, or corporate loans and transfer them to a special purpose vehicle, SPV. The SPV finances the asset purchase by issuing securities to investors, who receive cash flows generated from the underlying assets. This process separates the assets from the originating institution, reducing bankruptcy risk and enhancing investor confidence. Securitization improves liquidity, diversifies funding sources, and allows institutions to transfer credit risk. It also supports balance sheet management by freeing capital for additional lending activities. The topic further explains the major participants involved in securitization transactions and their respective functions. The originator creates or owns the underlying assets and transfers them to the SPV. The SPV serves as a legally separate entity that isolates assets from the originator's balance sheet. Servicers collect payments from borrowers and distribute cash flows to investors according to contractual arrangements. Rating agencies assess the credit quality of issued securities, while underwriters structure and market the securities to investors. Trustees and legal advisors ensure compliance with transaction terms and regulatory requirements. Effective coordination among participants is essential for maintaining transparency, operational efficiency, and investor confidence throughout the securitization process. Topic also focuses on cash waterfalls, SPV structures, securitization benefits, and credit enhancement techniques. A cash waterfall determines the order in which cash flows generated by underlying assets are distributed among different classes of investors. Senior tranches receive principal and interest payments first, while subordinated tranches absorb losses and receive payments later. SPV structures are designed to isolate assets legally and ensure that investors rely primarily on asset performance rather than the financial condition of the originator. These structures improve credit quality and reduce bankruptcy exposure. By redistributing risks and cash flows strategically, securitization structures attract investors with varying risk tolerances and investment objectives. The topic also examines the benefits of securitization and the importance of credit enhancement mechanisms. Securitization provides originators with liquidity, lower funding costs, risk transfer opportunities, and regulatory capital relief. Investors benefit from diversified exposure, customized risk-return profiles, and access to structured investment products. Credit enhancement techniques improve the reliability of cash flows and increase investor confidence in securitized instruments. Internal enhancements include over-collateralization, reserve accounts, excess spread, and subordinated tranches. External enhancements may involve guarantees, insurance, or letters of credit provided by third parties. These mechanisms reduce default risk for senior investors and improve the marketability and ratings of securitized products. Topic also further discusses performance analysis tools used to evaluate securitized structures and monitor portfolio quality. Analysts examine delinquency rates, default rates, recovery rates, prepayment behavior, and collateral performance to assess transaction stability. Stress testing and scenario analysis help estimate how securitized structures perform under adverse economic conditions such as rising unemployment, declining property values, or increasing interest rates. Cash flow modeling is also essential because securitized products often contain complex payment structures and embedded risks. Investors and risk managers rely on these analytical tools to evaluate tranche performance, estimate expected losses, and determine whether credit enhancements remain sufficient during changing market environments. Topic also introduces securitized structure ratios used to measure the strength, efficiency, and credit quality of securitization transactions. Key ratios include collateral coverage ratios, delinquency ratios, loss coverage ratios, and debt service coverage measures. These ratios help analysts evaluate whether cash flows generated by underlying assets are sufficient to meet obligations owed to investors. Excess spread ratios measure the difference between income generated by collateral and payments required on issued securities, providing additional protection against losses. Over-collateralization ratios indicate the extent to which asset values exceed outstanding liabilities. Strong ratio analysis supports risk assessment, pricing decisions, credit rating evaluations, and ongoing monitoring of structured finance transactions. Topic also focuses on prepayment forecasting, which is a critical component of valuing and managing securitized products, particularly mortgage-backed securities. Prepayment occurs when borrowers repay loans earlier than expected through refinancing, property sales, or accelerated principal payments. Prepayment behavior significantly affects the timing and amount of cash flows received by investors. Falling interest rates often increase refinancing activity, while rising rates generally slow prepayments. Financial institutions use statistical models, historical data, economic indicators, and borrower characteristics to forecast prepayment rates accurately. Because prepayments alter expected maturity and yield profiles, accurate forecasting is essential for pricing, hedging, and risk management within structured finance markets. Finally, topics emphasize the complexity and importance of securitization within modern financial systems. Securitization improves liquidity, diversifies funding sources, and facilitates efficient transfer of credit risk across investors and institutions. However, these structures depend heavily on accurate modeling of cash flows, defaults, prepayments, and correlations among underlying assets. Weak underwriting standards, excessive leverage, or inaccurate assumptions can lead to severe losses and systemic instability, as demonstrated during the global financial crisis. Effective securitization management therefore requires strong governance, transparent disclosure, robust performance monitoring, and conservative risk assessment practices to maintain investor confidence and financial market stability.